The air in the Tokyo data center hums with a mechanical, indifferent chill, the sound of 10,000 servers processing the quiet end of the American century. It is January 6th, 2026, at 8:47 p.m. Eastern Standard Time, while the New York Fed is nursing the dregs of a Tuesday afternoon, and the mainstream media is still polishing the soft landing headline. A PDF document quietly uploaded to the Bank of Japan's server. It isn't a manifesto. It is a suicide note for the global status quo. Within 90 minutes, the U.S. 10-year Treasury yield, the very bedrock upon which every mortgage, car loan, and retirement account on Earth is built, suffers a violent 42 basis point convulsion. In the sterile, high-frequency world of sovereign debt, this is the equivalent of an 8.0 magnitude earthquake hitting a glass city. This is the Black Monday of the bond market, occurring in total, digital silence. While you were sleeping, the foundation of your bank account was liquidated by a keystroke 6,000 miles away. This isn't just another day of market volatility. The core conflict is a forensic nightmare. For decades, the Federal Reserve and the Treasury Department have peddled a narrative of resilience and soft landings, promising that inflation was under control and the deficit was manageable. But the reality is that the U.S. has been surviving on a life support machine funded by Japan, the world's largest creditor. That machine just ran out of power. Japan currently sits on a $1.1 trillion mountain of American debt. They aren't just an ally. They are the primary financier of the American lifestyle. But as the yen spikes to a devastating 161 against the dollar, the Bank of Japan has been forced into a corner. Facing a domestic debt-to-GDP ratio of 264%, they can no longer afford to subsidize the U.S. deficit. The spike you see on the charts, that vertical line in Treasury yields, is the sound of the world's most loyal buyer dumping $1.2 trillion in U.S. debt into a market that has no one left to buy it. This is the key insight the talking heads on CNBC won't tell you. This isn't a market correction. It is a forced liquidation. It is a sovereign betrayal born of necessity. Japan is burning the furniture to keep their own house warm, and the furniture they are burning is the U.S. Treasury market. The bridge to history is hauntingly clear. In the final days of the Roman Empire, the central authority didn't just collapse overnight. They began clipping the silver from their coins, debasing the currency to fund a deficit they could no longer sustain through growth. Today, the clipping is digital, and the empire is the U.S. dollar. You are living inside a debt trap that has finally snapped shut. By April, when the Japanese fiscal year concludes and the final $200 billion in repatriation sales hits the tape, the soft landing will be revealed for what it truly was: a lethal hallucination. The camera pushes past the server racks and into a dimly lit trading floor in Midtown Manhattan. It's 3 a.m. A lone analyst, fueled by cold espresso and the blue light of 4 monitors, stares at a spreadsheet that shouldn't make sense. This is the infinite money glitch, the financial plumbing that has quietly pumped the global bull market for 3 decades. It's simple math that scaled into a monster, the narrator says, footsteps echoing on the hollow floor. For 30 years, the Bank of Japan, BOJ, kept interest rates at 0, or even negative. If you were a hedge fund, a pension board, or a high-frequency shop, the trade was mechanical. You borrowed billions in yen at 0% interest, sold that yen for dollars, and parked the cash in U.S. Treasuries yielding 4.5%, or poured it into Magnificent 7 tech stocks. You pocketed the spread, risk-free, on the back of a dying Japanese currency. But the official numbers, the $1.7 trillion cited by the BIS, are a sanitized lie. They only track the visible balance sheets. They ignore the rehypothecation, where one bond is used as collateral for 5 more loans. They ignore the dark pools and the shadow banking derivatives. The real exposure, the total leveraged weight of the world's bets against the yen, is closer to $20 trillion. That is nearly the entire GDP of the United States, all balanced on a single assumption, that Japan would stay broke forever. The paradigm didn't just shift, it shattered. Japan's lost decades of deflation are over. Inflation isn't a ghost anymore, it's a crisis. As of January 2026, Japanese core inflation has stayed stubbornly above 2% for nearly 4 years. The BOJ, cornered by a collapsing yen and rising food costs, was forced to hike rates to 0.75% in December, with more coming. The carry trade has officially become the carry trap. Every basis point the BOJ raises is a tightening of the noose around the neck of the S&P 500. When the funding currency gets more expensive, you don't just exit the trade. You liquidate. You sell your Nvidia, you sell your Bitcoin, and you sell your treasuries to buy back the yen you borrowed before the exchange rate wipes you out. The bridge to history is haunting. In 1923, the Weimar Republic thought they could outprint their problems until the cost of a loaf of bread hit 200 billion marks. Today, the trap is the same, only the medium is different. We swapped printing presses for digital ledger leverage. You are living inside a $20 trillion margin call that is scheduled to hit its breaking point by April. The scene shifts to a wide, low-angle shot of the Ministry of Finance in Tokyo. The building is a fortress of gray stone, but inside, the math has become a monster that no one can tame. A senior analyst sits at a mahogany desk, staring at a single figure on his terminal that has finally crossed the Rubicon: 1.1 quadrillion yen. That is Japan's national debt, and it is the heaviest object in the financial universe. The numbers don't just speak, they scream, the narrator says, walking through the quiet, sterile corridors of the ministry. Japan's debt-to-GDP ratio has bloated to 264%. For 30 years, this was a manageable ghost because interest rates were held at 0. But the ghost just grew teeth. The forensic reality is brutal. For every 1% rise in interest rates, the Japanese government is hit with an additional 3 trillion yen, roughly $20 billion, in interest payments alone. That isn't just a budget line item. It is the entire annual budget of several ministries combined, vanished into the ether of debt service. Tokyo is now locked in what economists call a death spiral, facing an impossible choice that will dictate the fate of your bank account by April. Choice 1: raise rates. If the Bank of Japan hikes rates to save the yen from total collapse, they effectively bankrupt their own government. At 3% interest, a level the market is already beginning to price in, debt servicing would consume over 25% of the entire national tax revenue. Imagine a quarter of every yen collected from 125 million people going solely to pay the interest on old loans. It is a sovereign insolvency event occurring in slow motion. The domestic economy would buckle under the weight of frozen credit and collapsed housing prices. Choice 2: keep rates low. If they stay at 0 to protect the budget, the yen becomes a furnace. it hyperinflates. We've seen this before, from the assignats of the French Revolution to the Hungarian pengo. A weak yen makes every drop of imported oil and every grain of imported wheat exponentially more expensive for the Japanese public. The bonus stage of cheap credit is over. The cost of living is now the cost of survival. People are watching their savings evaporate not in a market crash, but at the grocery store checkout line. The third path, desperation. Instead of choosing between bankruptcy and hyperinflation, they are pivoting to a third, more dangerous strategy, the great liquidation. To prop up the yen without hiking rates into a suicide mission, Japan is being forced to sell its crown jewels, its $1.1 trillion stash of U.S. treasuries. This is the bridge to the Spanish Empire's financial collapse in the 16th century. They had all the silver in the New World, but their debt grew faster than the ships could sail. They eventually defaulted because they ran out of liquidity at the exact moment their creditors demanded payment. Today, Japan is burning the furniture to keep the house warm, and the furniture they are burning is the very debt that keeps the U.S. government afloat. The trap isn't coming. You are sitting in it. And by April, the door locks. The heavy limestone walls of the Federal Reserve Bank of New York on Liberty Street feel less like a fortress tonight and more like a tomb. Inside, the plumbing of the global financial system is springing a leak that no amount of spin can plug. If money is the blood of the economy, the repo market is the heart that pumps it, the narrator says. The sound of a flickering fluorescent light hums in the background, and right now, that heart is skipping beats. Treasuries are the pristine collateral of the world. They are the high-grade lubricant used to back trillions of dollars in overnight loans that keep the global engine from seizing up. When Japan, the single largest foreign holder of this collateral, begins its $1.2 trillion purge, it isn't just selling paper. It is pulling the oil out of the machine. Without that lubricant, the gears of the repo market start to grind. The friction manifests as a sudden, violent spike in borrowing costs, a mechanical failure that signals the end of the easy money era. The data from the January 3, 2026 Treasury auction confirms the rot. The bid-to-cover ratio, the primary gauge of market demand, collapsed to a staggering 2.18. In the sovereign debt world, that is a flat line. For decades, we relied on a gentleman's agreement, where foreign central banks would always show up to buy our debt. But on January 3rd, they didn't just skip the meeting. They burned the invitation. They are stepping away because they see what we refuse to acknowledge. The U.S. Treasury has transitioned from a safe haven to a toxic liability. This leaves the primary dealers, the Wall Street titans, holding a bag of burning trash. By law, they must absorb the debt the world rejects. Suddenly, their balance sheets are bloated with depreciating bonds. To save themselves, they strike back, flooding the market with short futures contracts to hedge their losses. This is the trigger for the gamma flip. In a stable market, these dealers buy the dips to keep prices steady. But once the gamma turns negative, the math reverses. The machines, the predatory algorithms, are forced to sell into weakness and buy into strength. It creates a self-reinforcing doom loop where the very people supposed to stabilize the market become the ones lighting it on fire. By April, as the Japanese fiscal year closes and the final $200 billion in repatriation selling hits the tape, the liquidity vacuum will turn into a total blackout. The choppy, dark waters of the East China Sea serve as a grim backdrop for a divorce that has been 30 years in the making. This isn't just a crisis of spreadsheets. It is a fundamental shift in the tectonic plates of global power. For 40 years, the U.S.-Japan relationship was defined by a shield and checkbook alliance. The United States provided the Pacific Fleet to guard Japan's shores, and in exchange, Japan provided the capital to fund the American deficit. It was a symbiotic machine, until the math stopped working. The forensic contrast between our allies and our rivals is staggering. Since 2022, China has been offloading its U.S. Treasury holdings with the cold, calculated precision of a chess master. Beijing has trimmed its stash to a 16-year low of roughly $682 billion. These moving that wealth into a fortress of gold and physical commodities. They prepared for a world where the dollar is a weapon they no longer need to carry. But Japan, the loyalist, stayed in the burning building. Tokyo kept buying and supporting the Treasury auctions, even as interest rates began to eat their domestic economy alive. They were the last pillar holding up the ceiling of the American debt market. Japan isn't selling now to be aggressive. This isn't a strike from a geopolitical rival. It's a desperate act of survival by a friend who can no longer breathe. When the most loyal buyer in the room, the one who stood by you when everyone else fled, finally stands up and screams for the exit, the room is officially on fire. The signal is being received loud and clear in Seoul, Taipei, and London. To the global finance community, Japan was the vassal state of the US dollar. If Tokyo is liquidating its holdings to save its own currency, the safe haven narrative is officially toxic. This is the bridge back to 1971, when France demanded gold and Richard Nixon was forced to close the gold window to prevent a total drain of the Treasury. Today, the gold is liquidity, and Japan is taking theirs back. The scene shifts to the frantic, high-speed pulse of the open market. The green and red numbers on the ticker tape aren't just data points anymore. They are the heart rate of a system in tachycardia. The problem with a globalized financial plumbing system is that you can't have a leak in Tokyo without a flood in New York, the narrator says. The sound of a static-heavy news broadcast hums in the background, reporting on unprecedented volatility. When the $20 trillion carry trade unwinds, the smart money doesn't sell what they want to sell. They sell what they can sell. This is the liquidity vacuum. Because hedge funds and institutional desks borrowed yen to buy the world. When those yen margin calls hit at 3 a.m., they need cash instantly. They don't wait for a good price on their long-term winners. Sure, they dump their most liquid assets to cover the hole. This is why the Magnificent Seven tech giants suddenly look like falling knives. The forensic data shows the pattern. NVIDIA, the crown jewel of the AI boom, has become the ATM of last resort. In late 2025 and early 2026, we saw record-shattering $400 billion swings in its market cap. These weren't shifts in company fundamentals. They were the desperate gasps of yen-carry investors being liquidated by the machines to pay back Japanese lenders. Then there is the canary in the coal mine, Bitcoin. Despite the marketing of crypto as digital gold or an uncorrelated hedge, the reality is a trap. In a true liquidity crisis, Bitcoin is treated as high beta risk. It is the first asset sacrificed to save a failing margin account. As the yen spiked in January 2026, Bitcoin didn't rise. It cratered to $81,000 in a brutal flash crash. proving it is still tethered to the very dollar liquidity system it claims to bypass. This is the bridge to the 2008 Great Financial Crisis. Back then, it was subprime mortgages that acted as the toxic sludge in the pipes. Today, the toxicity is the yen carry leverage itself. You are living inside a $20 trillion margin call that has no lender of last resort. By April, as the final Japanese corporations square their books for the fiscal year end, the vacuum won't just pull at your stocks. It will swallow the entire concept of a safe 401k. The archive room feels colder now, the shadows of past failures stretching across the floor. We aren't looking at history books. We're looking at blueprints for a recurring disaster. Wall Street has a short memory, but the math never forgets, the narrator says. The sound of a projector clicking through old slides fills the silence. To understand the April deadline, you have to look at the wreckage of 1997 and 2008. The patterns aren't similar. They are identical. We start in 1997. It began with the Thai baht, a minor currency in a mid-tier economy. When it floated and collapsed, it triggered a contagion that obliterated long-term capital management, LTCM, the most sophisticated hedge fund in history. LTCM didn't die because they were wrong about the world. They died because their yen carry trades and interest rate spreads blew out simultaneously. The Federal Reserve had to organize an emergency bailout to prevent a total systemic meltdown. That crisis started with Thailand. Now imagine that same fuse attached to Japan, the third largest economy on Earth. Fast forward to 2008. The world remembers the housing bubble, but the forensic cause of the great financial crisis was a repo freeze. The collateral turned toxic, and the plumbing of the global banking system stopped overnight. Today, we are facing a repo freeze 2.0. Only this time, the toxic collateral isn't a subprime mortgage. It's the U.S. Treasury bond itself. When Japan dumps $1.2 trillion in debt, they aren't just selling bonds. They are removing the very foundation of the global repo market. But here is the trap that makes 2026 different, the narrator says, stopping in front of a chart of the U.S. national debt. In 2008, the Federal Reserve had a full magazine of ammunition. The national debt was a mere $10 trillion. Interest rates were low, and inflation was non-existent. They could print $4 trillion to save the banks without breaking the dollar. In 2026, the Fed is a cornered animal. Debt has exploded past $34 trillion. Inflation is a persistent fire they can't put out. If Jerome Powell prints money to buy the treasuries that Japan is dumping, he will reignite a hyperinflationary spiral that destroys the dollar's purchasing power. If he doesn't print, the treasury market freezes, and every asset class you own goes to zero. There is no middle ground left. By April, the Fed won't just be out of ammunition, they will be the target. In the world of international finance, April 1st isn't a day for jokes. It's the day the ledger is settled. For Japan, it is the edge of the world. Every year, as March turns to April, the Japanese fiscal year comes to a hard close. This is the moment when the whales of the global market, Japan's massive corporations, insurance giants, and pension boards, are legally and practically required to square their books. They bring their profits home. They repatriate their capital. In a normal year, this is a routine accounting exercise that the markets absorb with a shrug. But in 2026, this isn't routine. it is a mass exodus. Because the yen has been so volatile and the Bank of Japan has finally abandoned its zero-rate policy, these institutions are no longer just rebalancing. They are fleeing. They are selling their overseas assets, primarily U.S. stocks and treasuries, and buying back yen to shore up their domestic balance sheets before the year-end deadline. The fiscal cliff we are facing in April is a convergence of three lethal events that have never happened simultaneously. First, the Bank of Japan's policy shift has turned the yen into a liquidity vacuum, sucking cash out of Western markets at a rate of billions per hour. Second, the U.S. Treasury is hitting a massive maturity wall, where billions in old, cheap debt must be refinanced at these new, punishingly high interest rates. The government is essentially trying to take out a new mortgage while the bank is raising rates in real time. Finally, the Federal Reserve's reverse repo facility, the emergency slush fund that has kept the shadow banking system afloat for years, is officially projected to hit zero by the end of March. The lubricant is gone. By April, the U.S. Treasury will be forced to sell more debt into a market where its largest buyer has become its largest seller. It is a perfect mechanical failure of the debt machine. You can't negotiate with a deadline. By April, the forced liquidations move from the hedge funds to the sovereign level. The cliff isn't ahead of us anymore. We have already stepped off the edge. The lights on the Board of Governors floor at the Federal Reserve in Washington, D.C., stay on long past midnight. This is where the soft landing fairy tale finally meets the cold, mechanical reality of a global margin call. Jerome Powell and the Fed are no longer in control of the narrative. They are reacting to a physics problem they can't solve with a press release. As Japan's forced selling pushes the 10-year Treasury yield toward the red zone of 5.5%, the Fed faces a binary choice that will redefine the American economy for the next century. The policy pivot. QE infinity. Forensic data and recent forecasts from Deutsche Bank and J.P. Morgan suggest the Fed is already reaching its limit. By April 2026, as the Treasury market liquidity evaporates, when the Fed will be forced to restart quantitative easing, QE, likely framed as reserve management, to prevent a total freeze of the credit markets. This is the moment they admit the market can no longer function without the printing press. To stop the gears from seizing, they will step in as the buyer of last resort, swallowing the trillions in debt that Japan and other allies are dumping. The consequences. The great decoupling. This admission of defeat has a lethal side effect. For years, the dollar and the yen have been locked in a choreographed dance. But a return to QE while inflation remains stubbornly near 3% will cause the dollar/yen pair to decouple. The market will realize the Fed is sacrificing the dollar to save the bond market. As the Fed prints, the dollar's purchasing power begins a terminal decline. Yet the safe haven status of U.S. debt isn't just questioned, it is discarded. The flight to hard assets. This is why the smart money, the sovereign wealth funds and ultra-high net worth allocators, is orchestrating a massive rotation into physical reality. They are moving out of paper assets and into physical silver and gold. As of late January 2026, the gold-to-silver ratio has compressed from its historical highs to a decade low near 50-1, as silver stages a black swan rally past $113 an ounce. The forensic evidence shows a massive disconnect between the paper prices on the COMEX and the physical reality in the vaults. The London bullion market and the COMEX are reporting dangerously low inventory levels, with nearly a quarter of registered silver vanishing in a single week. The paper markets, long used to suppress prices through rehypothecation, are failing. In a world of digital leverage, physical metal has become the ultimate unprintable insurance policy. You are watching the transition from a market economy to a command economy, where the Fed prints to keep the government alive while the currency dies. By April, the trap will be revealed. The Fed can save the banks, or it can save the dollar. It cannot do both. The high-speed hum of the Tokyo data center from the opening scene has been replaced by a heavy, expectant silence. We started this investigation at 8:47 p.m. on a Tuesday in January, but the clock has now reached the 11th hour. The evidence is no longer hidden in the fine print of obscure Bank of Japan statements. It is screaming from the tape. The $20 trillion carry trade isn't just a financial term, the narrator says, standing before a darkened window overlooking the gridlock of a city at night. It is the structural support of the world you live in, and it is unwinding in real time. This is not a drill. It is a fundamental reorganization of the global financial system. The final analysis is purely mechanical. There is no room for optimism or hope in a forensic audit of this scale. You need to watch two numbers. First, the U.S. 10-year Treasury yield. If that number crosses and holds above 5%, the interest expense on the $34 trillion American debt pile becomes an unpayable tax on the future. Second, watch the yen/USD exchange rate. If the yen stays entrenched above 160, while the Bank of Japan is forced to hike rates, the liquidation has officially gone kinetic. This is the moment the avalanche becomes unavoidable. The trap that was set 30 years ago is finally closing. The Federal Reserve, the Bank of Japan, and the European Central Bank have spent a generation pretending that debt doesn't matter as long as you can print the interest. But Japan, the world's most loyal financier, has just proven that even the largest printer has a limit. They are choosing their own survival over the stability of the US dollar. So, how do you survive a $20 trillion margin call? You have to move beyond the traditional 60-40 portfolio. That model was built for a world where bonds were a safe haven and the yen was cheap. That world died on January 6th. Your new priority is liquidity and counterparty risk. In a systemic liquidation, you do not want to hold assets that are merely promises to pay from a bankrupt institution or a cornered government. You must focus on assets that are not someone else's liability. Physical gold, silver, and hard commodities are the only things that don't vanish when the infinite money glitch is patched. You need to verify your own plumbing, your bank's FDIC exposure, your brokerage's solvency, and your own access to cash. The bridge to history is the Great Depression. Those who survived weren't the ones who bought the dip in 1929. They were the ones who saw the credit contraction coming and stepped out of the way of the falling debris. By April, the forced repatriations will be complete. The ledger will be settled. The question isn't whether the system will crash. It's whether you'll be standing on the foundation or buried under the rubble when it does. The investigation is over. The numbers are in. The liquidation has begun.